The United States of America needs a recession to save our economy. At least that's according to JP Morgan Chase Bank, who says that our economy needs a recession. Let me read you what JP Morgan Chase Bank, the largest bank in the United States, said in a note to their investors. They said, while the United States economy's recent resilience may delay the onset of a recession, we believe that most of the lagged effects of 2022's monetary tightening have yet to be felt, and ultimately a recession will likely be necessary to return inflation to target. What does that mean? In 2022, the Federal Reserve Bank started raising interest rates for the first time. We started off slow with those 25% interest rate hikes, the 0.25% interest rate hikes. Then we got more aggressive with the 0.75% interest rate hikes, and we continued to do that throughout all of 2022, and we have continued to raise interest rates a little bit in 2023. And what JP Morgan Chase Bank is saying is that we haven't felt the full effects of last year's interest rate hikes, and we're still raising interest rates now. Now, in order to bring inflation down, right, the Fed has to raise interest rates, and there is a lagged effect, a delayed effect to the pain from higher interest rates, which you haven't felt yet. The general rule of thumb is that it takes somewhere between 12 to 18 months to feel the effects of interest rate hikes. We're now starting to feel the pain of 2022's interest rate hikes, which JP Morgan Chase Bank says that we haven't fully felt yet. And they're saying that, number one, we still have to feel more of that pain. And number two, in order to really bring inflation down, we're going to have to see more of this economic pain. What they said, a recession, that it might be necessary in order to bring inflation down. And the reason why is, well, you can think about it, especially with housing prices. Because CPI, our inflation data, is made up of a lot of different components, and one of the main components in that is housing. So when you have a lot of people with money to go out and buy a home with low interest rates, what happens? Everybody wants to buy a home. Now you have a home listed for $400,000. You have 35 different offers, and the home sells for $475,000. Home prices go up. Now when home prices go up, that data goes to the inflation, the CPI data, which says home prices went up. Inflation is higher. When inflation is higher, the Federal Reserve Bank has more fuel to continue raising interest rates. So now, when you have, say, higher interest rates, demand starts to go down. But it hasn't gone down to the point where we're seeing inflation really fall to the levels that the Federal Reserve Bank wants. This is why the Fed keeps saying that bringing inflation down has not happened yet, and it's going to take more work. So now what happens if you have a recession? If you have a recession, now that means the economy is slowing. And generally that would mean that less people are going out to buy homes. And generally that would mean that, well, sellers would be having to cut the prices of their homes to get their homes sold. So now let's play that scenario together. If sellers are having to cut the prices of their homes, home prices would generally be falling. If home prices are falling, well, that's going to go to the CPI data that says home prices haven't risen, they've fallen. What does that do to the inflation numbers then? That's going to cool down the inflation numbers, because now instead of seeing more prices of things growing, we have the prices of some things falling, which would help average out to hopefully a lower inflation number, at which point then there's less fuel to continue raising interest rates, because then you have some corrections in the inflation numbers. This is where JP Morgan is saying that we need a recession to actually bring inflation down to the 2% target, because what they're saying is that the current efforts by the Fed are not enough. The current interest rate hikes are not enough. The current quantitative tightening has not been enough to bring inflation down. Now, we did a full deep dive of this story in Market Briefs, which is my free financial newsletter. If you have not joined Market Briefs yet, it's a free and easy way for you to stay up to date on what's happening in the economy, the housing market, the stock market, and the global economy. That way you don't get blindsided about what's happening, so you can be on top of what's happening when it's happening. You can read the newsletter in 5 minutes every morning, and it's completely free. If you have not joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market. And I also got the link for you down in the description below. In June of 2023, we saw our stock market hit a brand new bull market, because we saw the stock market constantly going up and up and up, and everybody said, oh, all these recession worries are gone, the economy is booming. But you have to pay attention, not just to what's happening in the noise and the news and what banks are saying, but you have to pay attention to what actually smart or real investors are doing. because, well, JP Morgan has a lot of insight. So let's see what they're actually doing. They said that they're maintaining a defensive asset allocation and believe the risk reward for equities, meaning stocks, remain poor given the disconnect between stocks and bonds. There's a high likelihood of a recession in the coming quarters. There's high interest rates, tightening liquidity, and rich valuations, and the still narrow market breadths. There's a lot of things that they said in that one sentence that I really want to break down, because now you can really understand now if this is the largest bank in the United States and they're making investments based off of, well, not what's happening in the current state of the markets, not what's happening in the news. It's something for you to pay attention to, because we've heard a lot of news, especially when the stock market's going up, that the economy is booming and everything is great. And what does that really mean? Because what you have to understand is that recessions don't happen when people expect them to happen. They happen when people stop believing that they're going to happen. And what JP Morgan Chase Bank is saying is that the investment into equity stocks still does not seem like the best investment for them because of all the factors that they highlighted. They talked about the likelihood of a recession coming in the coming quarters. What does a recession do? That generally brings asset prices lower, stock prices lower. So because of that, they said this might not be a good time for them to be dumping a ton of money into the general stock market. The second thing they said in that same sentence is higher interest rates. What do higher interest rates do? They make borrowing more expensive. They cool down demand. And what they're also saying is that we still have to feel the full effect of the higher interest rates, which we haven't felt yet. So they're saying that we're going to see more pain coming because of the higher interest rates. Third, tightening liquidity. Tightening liquidity means less money entering our economic system because banks are less likely to loan money. Banks are going through their own regulations to bring less money into the economy. That means less spending. Less ability for people and companies to buy assets. Less ability for people and companies to spend. Less spending means less economic growth because our economic system is designed on spending. The more money you spend, the richer somebody else makes. And when you have tightening liquidity, there's less spending ability, which means people and companies have less ability to spend money, which means less growth in the economy. And then they said rich valuations, which means essentially that they still believe that the stock market is overvalued. They say the stocks, essentially companies' valuations are too high, and because of that, they're not investing as aggressively into equities right now. This is directly from JP Morgan Chase Bank. Now, you don't want to blindly follow what they do. You don't want to blindly follow what I do. You don't want to blindly follow what anybody does, but rather understand the different opinions out there. That way you can make the best decisions for yourself, because guess what? When the stock market is booming, you start to see the sentiment that, oh, the economy is not going to see any recession, that the world is great, everything's fine, and nothing can go down. As soon as you start to see the stock market slightly go down, things flip. Everybody says, oh, we're going to enter a recession. Everything is bad. Everything is going to go wrong. The whole world is going to end. And this is where you, as a financially educated person, have to be able to cut through the noise, cut through the emotion, learn from different people. Some people think that the world is going to end. Some people think that the world is going to boom and the economy is going to boom. And you have to be able to find the right information to help guide your investments. Instead of being an emotionally driven investor, be an educated and financially driven investor. What we know at the time when we're recording this video is that, well, inflation is still high. We're seeing the economy slow down, and we're probably going to see more interest rate hikes coming. The Federal Reserve Bank has made this very clear that they expect to raise interest rates more in the future. These higher interest rates, again, make borrowing more expensive, which means less spending, which means a further slowdown in the economy. And at the same time, now you look at what's happening in a job market, and you might be saying, well, none of this is making sense. We're having a slowing economy. We have inflation. We have all these problems that people are talking about, but companies cannot find enough workers. People can get jobs. How is this all adding up? But you have to now put this all in perspective based off of what's happened over the last few years. Remember, JP Morgan hinted at this too. We have seen so much money printing, especially from 2020 to 2022. Now, what did this money printing do? Well, of course, it gave people the ability to spend, but it also gave businesses the ability to spend, right? We saw billions and billions of dollars given to these corporations and businesses around the country. Now, we're handed so much free cash with zero strings. What are you going to do? Well, some obviously use this in bad ways, but businesses that are smart are going to take this money and they're going to want to invest it into new divisions, new stores, new manufacturing, new research, which means new employees. So we saw all this money enter our economic system, and no crap, we saw this huge boom in the job market because businesses had so much money to spend. They had the ability to create new jobs. And this is what the Federal Reserve Bank is working to correct. They're working to change what happened in the last few years. They want to cool the labor market. Why? Because they feel like too many jobs were created, that's also fueling the inflation problem. So what do they want to do? They want to correct that. They want to correct that through demand. Because now, if Chipotle has less people walking through their door, there's going to be less people spending money, or less money that's going into Chipotle. If less money is going into Chipotle, they're not going to be able to open new stores. They might have to shut down some stores. They might have to shrink some of their research or some of their tasting departments, which means less jobs needed at the company. Now, I'm just talking about Chipotle as a hypothetical, but that's essentially what higher interest rates do. They cool down demand, which cool down spending, which cools down the economy. And this is what JP Morgan is highlighting, that you don't want to just pay attention to short-term movers in the market, because there's a lot of things that can influence the short-term moves. The stock market is very emotional, but you got to pay attention to the trends. There's a lot of money that was created in 2020, 2021, and even into 2022. It's going to take time for that all to kind of fizzle through our economy, and then for the higher interest rate effects to be felt. And not just that, we're still raising interest rates. So now as interest rates go higher, we're going to start to feel the effects of previous interest rate hikes, and then we still have to feel the effects of the more recent interest rate hikes. These things are going to take time. And this is where JP Morgan is saying that they're anticipating opportunities coming in the coming years because of everything that's been shifting in our economy. Now, a lot of people don't have that patience to sit there and watch it happen. They want to see either the crash tomorrow or they want to see the boom yesterday. And this is where you got to be willing to be patient and understand what's happening. That way you can actually capitalize on this. And this is where you want to pay attention to what some of the different players are doing. You want to pay attention to what people are saying and not get caught up in the noise, not get caught up in the emotion, and not just blindly follow what anybody else is doing. Now, of course, we're keeping you updated and market briefs. That way you can stay up to date on what's happening, when it's happening. But this is where your job as a financially educated person is to, number one, get prepared, and number two, be financially educated. I say that 2023 is not the year for you to go out and finance a brand new truck, because this is the year for you to get financially smart. That way you can get prepared of putting money aside for your investments, putting money aside to capitalize on more investment opportunities. And then number two, building your financial education. That way you can actually see the opportunities when they happen. Because, well, you can have the money put aside, but if you don't know how to find a good investment from a bad investment, it doesn't really do you any good. And that's where you need to be investing in your financial education. Learn about investing, read books on investing, maybe take classes on investing, and then do it yourself, because you cannot bypass the experience. That way you can then have the ability to capitalize on opportunities and have the education to find the opportunities, because those two things together can help you dramatically increase your wealth, because you might be able to find great investment opportunities at a huge discounted price. Most people don't want to believe this, but you don't need to make a lot of money to become a millionaire. If you can invest $4 a day, or even just $100 a month, that's less than $4 a day, you can become a millionaire. Numbers have showed us this from history. If you can invest $100 a month, that's less than $4 a day, and you can get an average